Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, also known as Mr. Valuation. It's once again my pleasure to showcase another subscriber request Tuesday where subscribers to the channel ask me to cover certain stocks or certain industries. And I always enjoy that because it lets me, kind of make contact with the subscribers, know what you're interested in, what you want to see and what you want to look at. And this particular week is kind of interesting for me because for some reason, I don't even really can't tell you why, it's an industry that I've personally overlooked, and that is the trucking industry. Okay, so I was asked to cover 4 trucking stocks here, which I'll cover here in a moment for you, but I also thought I'd do something a little different, a little interesting. Normally, when I do videos like this, I prepare, I do some research and some due diligence on them. Well, this is an industry that I'm totally unfamiliar with. But even when I'm familiar, before I actually go into a lot of comprehensive research and due diligence, I look to FastGraphs as my first step. And I kind of go through a FastGraphs process where I look at different metrics, look at balance sheets and income statements and cash flow statements and other ratios and things to try to determine whether or not a stock is actually research worthy or not. Of course, the first thing has to happen for me to want to do that is I've got to consider the stock attractively valued. And this industry, I haven't seen a lot of valuation in this industry, and that might be one reason why I've tended to overlook it. But what's happening is we're starting to see in some cases of this group, which I'll show you, valuations are starting to come into alignment. And yet there's one example here, which I consider maybe what looks like might be the best transport or trucking company is also sky high in valuation. So a lot of times you'll see industries run, kind of in tandem. They'll all be overvalued or all be undervalued, et cetera. So what I'm going to do here, I'm going to go through this as a kind of, am I interested in researching any of these stocks further? In order to determine that, I'm going to run them through the FastGraphs Fundamentals Analyzer software tool and go through various metrics with you. At the same time, be showcasing how I personally would use the tool to decide whether or not I wanted to conduct further research or not. So I'm going to go ahead and move to the FastGraphs. I'm going to start with Marten Transport, symbol MRTN. And, look at this company purely from a standpoint of the FastGraphs Fundamental Analyzer software tool. Now, to give you all some color, the black line on this graph are weekly closing stock prices. The orange line represents a kind of a discounted cash flow fair value formulation. In this case, we're looking at a PE ratio of 15, anywhere the stock price would touch the orange line. The market value line, or what we call the normal PE line, is the dark blue line on the graph. And that's simply a trimmed average of how the market has valued the stock. And what I'm looking at here is I'm getting a picture of what kind of business I'm looking at. What's its operations look like? How consistent? Now, when I'm looking at a long-term graph like this, I'm seeing that 12.28% has been the growth rate. That's calculating the growth from point A, which is December of 2003, out to the next year's estimate, which is December of 2022. That calculates out at a 12.28% growth rate, okay, which is very, very attractive. But I also want you to see another feature here that I don't showcase enough. If I click on this orange bars up here that have the years up here, I can switch that to a 15-year graph. Now, this is actually including a year and a quarter's worth of estimates, okay? So it's not 15 years of history. Here I've got the growth rate of 12.81%. That's pretty consistent. I drop it down to 10 years, I've got 12.92%. Again, pretty consistent. But if I look at the bottom of the graph, you'll see that I get different growth rates here, but they're averaging out around this 12 or 13% growth rate. Now, just real quickly, when I go to the forecasting graph, I see only 1 year of forecast here, a year and a quarter. I only get a forecast. It's not a widely followed stock. Note that there's only 4 analysts in here, but I'm getting a 14.78% forecast growth out to the end of this year, out to the end of next year. On a longer term trend line growth, I don't have any estimate data here, okay? So I'm going to ignore that. But the point is, so far what I've seen here is a company that has historically grown at double-digit rates. So I kind of like that. So I'm going to go ahead and keep this at around a 20-year graph here just to give you some color and make some points. Number one is it actually handled the recession pretty well. We did see coming prior to the Great Recession of 08, a couple of negative years of earnings. We also see that the company started paying a dividend in 2010, But we also see that once they started paying a dividend, they've had a pretty good record of increasing it along the way. And if I look at performance here, you'll see that the dividend was frozen for several years at 4 cents a share. Then they start growing it again pretty rapidly. So it's got a relatively short dividend history, and I'm not going to call it shaky because they've consistently paid a dividend, but they haven't grown it every year. So that's not something I like. But here's the point I want to get at is this orange line represents what I consider to be intrinsic value. And you can see when the price is above that, how often it moves back into its, what I would call intrinsic value, or back down to the intrinsic value line. I don't like to say reversion to the mean. I like to say reversion to value because I'm known as Mr. Valuation. And you see that happening over and over again. And we saw it even during COVID. When COVID came, it immediately dropped down to its fair value PE, but then it rallied again. And then more recently here, the stock has been correcting and it's getting real close to fair value again. The PE ratio, the blended PE is 15.65. It's got an earnings yield of we'll call it 4%. That's real close to being attractively valued based on my, personal preference for at least a 6.5 to 7% earnings yield. It's real close, not quite there yet. You can see it's getting real close to it looking at the forecasting calculator as well. And, given the growth potential, that would give us almost a 9.5 to 10% annualized rate of return. So I kind of like what I see here, and I'm interested in the fact that the valuation is starting to look attractive. So at that point right here, I might say, okay, I want to look further. Now, I'm using adjusted operating earnings here, which exclude a lot of accounting convention, but I also like to look at diluted earnings, which does include accounting convention, and I get a kind of an interesting perspective of how much accounting, of what kind of activity, if you will, the company's going through. And I do see a real strong surge in diluted earnings here, which partially explains this overvaluation that I saw in operating earnings. So that's another earnings metric, and this will give me different earnings yields and different PE ratios because I'm using GAAP numbers here. That's what the difference is. But since this is a dividend-paying stock, but it only has a 1% dividend yield and a very low payout ratio, I want you to notice it's only paying out, around 9 or 10% of its earnings historically. And that payout ratio increased a little bit last year to 16%. So, we have a lot of room for dividend growth if this company decides to get more oriented towards dividend growth. But currently, it looks like it's still a growth stock. So once I've looked at diluted earnings, I might like to go on to cash flow since it's paying a dividend. And here I'm using the market cash flow, not this orange line. Doesn't really have any relevance in this particular example. So I automatically am going to judge valuation if I'm going to judge valuation based on cash flow, based on the market value line, which is about 6 times cash flow is what the normal valuation of this stock has historically been. You can see that's the blue line on the graph. It's 5.99, or we'll call it 6%, or 6 times cash flow. And that becomes a very good proxy for valuation. The stock looks a little pricey at about 6.77 times cash flow here, but not crazy, just expensive. All right. But look how well the dividend is covered like a blanket in that regard. All right. So I really like that. Then I'm going to go to free cash flow, and free cash flow is a little more spotty. This is a trucking company after all. But I still get pretty good free cash flow coverage of the dividend. I don't usually use free cash flow as a valuation metric. I look at it more as, a opportunity to cover the dividend. That's what I'm most interested in when I'm looking at that. So anyway, that's what Marten Transport looks like using all those various metrics there. And then finally, last but not least, I will also like to look at companies based on things like EBITDA, which is earnings before interest, taxes, depreciation, and amortization. This is another very close to what I would call cash flow metric. And I do like to value stocks based on this metric, because I think this gives you a good indication because it really is an operating metric, if you will. It's earnings before you take out things like taxes. It's how's the business doing, if you will. And again, I'm starting to see it coming close to fair valuation. I could also look at EBIT if I wanted to. And then finally, I'm going to look at sales. Now, interestingly enough, on this is total revenues or sales, the company looks expensive on that basis. So as I've gone through this here with you, you can see as I go through these various metrics, this company looks pretty good on valuation using most metrics. So then the next thing I'm going to do is I'm going to go into the fund graphs here. All right. And again, I'm looking at sales and revenue growth here, which has been consistently growing. But what I really want to do is I want to look at some other issues here. I want to go into the ratios graph, and I want to go to profitability ratios, and I will look at gross and net margin. Now, the company has gross margins about 9 or 10%, up to 11 or 12% occasionally, and their net margins are much lower at 6 or 7%, but yet actually very high. So they do bring a lot of their gross down to the bottom line, but again, their gross margin is still relatively low at 10%, but good for this industry, I might point out. I would also, in this case, I would look at things like returns on equity and see what the returns on equity look like, because that would also give me a good indication of, how the company is performing as an operating business. So I'm looking at all these different metrics and all these different ways to look at the company, and I'm still trying to decide whether I want to actually get involved in more research and due diligence or not. Anyway, at this point, I kind of like what I see. There's other areas that I'll look at here. I'm going to try to kind of summarize this a little bit. I like to go into the in millions graph, and I like to look at shares outstanding and determine whether or not the company's been buying back stock or not. This company's been very, very stable with their shares outstanding. So, it's not good nor bad. In other words, they're not raising a lot of capital by issuing a lot of shares, which means they're not diluting me, and they're not necessarily buying back a lot of shares when they're expensive, because I do want to remind you that if looking at a stock from the perspective of the fast graph and looking at it from the perspective of earnings, which is the default go-to metric, most of the time this company is pretty expensive. The normal PE on this stock has been just under 20 over this historical time frame. And then finally, if I do like it and I think the company looks interesting, I'll go to external links. And the first place I'll go is I'll go into the company's website, and I'll start, trying to examine what the company does, how long it's been in business, why the company was named that way, because their founder was Roger Marten. So that, gives me some clue on who they are. I'll look at, things like their customers, what kind of businesses they're engaged in. And I can go through all of that by going into the website. And then, of course, I'll also look for external research. So anyway, Marten's looks pretty interesting to me as an opportunity to invest in a stock with pretty good growth. Now, there are some concerns, however, with this whole industry. We have a truck driver shortage right now. We have supply chain disruptions. Wall Street Journal actually had a major article on it today about that. So that's the cautionary stuff that before you would actually lay your money down, you want to look into more closely. But anyway, Marten Transport looks like it's getting close to being reasonably priced. There's not a lot of margin of safety yet, but this might be one that you'd want to keep your eye on and that I'd be personally interested in looking at. The next is Old Dominion. I consider this perhaps the premier company in the industry. One thing I do want to point out, if I go back to Marten, that I should have pointed out before I left it, was Marten is a $1.3 billion market cap company, and it has very, very low debt, which is kind of nice. So this is kind of a small cap, which was kind of interesting, which I think partially explains its growth. When I go into Old Dominion, and now I'm looking at a $33 billion market cap. I've got a very low earnings yield and a very low dividend yield, both, simply because this has been a strong grower. This company's grown at over 21% a year historically. I go through this same process, still stays at 20% growth, drop it down to a 9-year graph here, and it's at 22% growth. And if I look at it going forward, it's expected to grow at about 18% for the next couple of years. And I do have a long-term growth rate here expected to continue to be over 20%. So it's a very fast-growing trucking company, if you will. And I like that. It has, a very, very low dividend payout ratio. I'm not sure you'd even want to call this a dividend payer, but it has increased its dividend each year since it's been paying one. So I kind of like that. But again, it was a reasonably priced stock back in March of 2020. I would consider it significantly overvalued based on operating earnings. And again, I'll go through, I see the same picture when I look at GAAP or diluted earnings. I look at it from an operating cash flow point of view. I see it significantly overvalued. I look at it from a free cash flow point of view. I've got really great free cash flows, great dividend coverage. But again, I would even say here, I get a valuation reference, if you will, looking at it from a standpoint of EBITDA, and then looking at it from a standpoint of sales, the stock looks significantly overvalued. At this point, and this is critical to me, I would not waste any more time personally looking at Old Dominion. I might put it on a portfolio somewhere on a watch list, and I'd want to see this stock down at $185 a share to maybe 180 to say $195 a share before I'd even be remotely interested in it. But I also want you to see how consistently this company has tracked earnings at about a 21 multiple. And I'm using a generous multiple. I'm using a PE ratio equal to the growth rate. This is a growth stock. And even when I'm doing my forecasting graphs, I'm using a 18 multiple here on this near-term estimates, and on the long-term growth estimates, I'm applying a 20 multiple, which means this stock could still generate a good rate of return 3 to 5 years out if you bought it now, but it would not be a great investment over the short to intermediate term. So I wouldn't go any further looking at Old Dominion. I might take a peek at the business, go into their corporate website just to see who they are and what they do. But again, the problem is I'm scared away here with valuation. I love the company. I'd love to have an opportunity to invest in this company, especially as a growth opportunity, but I haven't had that opportunity from my disciplined valuation perspective since, the spring, if you will, of 2019. But, there were times when this could have been bought if you were interested in growth as an investment. TFI International is another one. It's a $10 billion market cap, pretty interesting. Again, a low yielding stock with low dividend payout ratios, yielding less than 1%. But again, that's functionally related to overvaluation. I do want you to see there's a surge in earnings growth expected, which has clearly increased the value. It did, have a flash crash in COVID, but this is something that befuddles me. I'm going to go ahead and interject this here. It just, with all this COVID and all this stuff that's going on and closures and, mandates and everything that's happening politically, it's amazing to me how optimistic the market continues to be here with these companies, how quickly they've recovered. This company is also expected to grow pretty quickly. It's getting technically close to being fairly valued based on the fact that it's got such high growth expectations. Long-term growth is an extraordinary 31%. Now, what I'll do when I see something like that, I like to check it against another source. So I'll go into Yahoo here, and Yahoo's saying 26% 3 to 5 year growth. With this, they get their estimates from Reuters. We're getting them from FactSet. So, there's actually a decent amount of growth here that's expected for this company over the next 3 to 5 years, which could mean that you might want to spend some time learning more about it. Once again, before I did that, I would go through and look at all the other GAAP earnings, have maybe partially explained why we've had such a surge. We've had almost an 88% surge in GAAP earnings in the last year. Operating cash flows have been very strong, but this company normally trades at around 7 times operating cash flow. EBITDA, looks real good. Free cash flow, I kind of skipped over it, but I might as well go back to it. Free cash flow really covers the dividend extremely well, and the stock, is expensive if you recognize that it normally trades at 8 times free cash flow, not the 15 times free cash flow that the orange line is representing on the graph. And then last but not least, when you look at it from a sales point of view, sales growth is expected to be very strong this year, which might explain some of the euphoria. But longer term, it doesn't look like sales are going to be all that great. So I would consider this one another one that I probably wouldn't be real interested in doing a deep dive on it, spending a lot of time researching at this point until I saw a better valuation. That's my own personal bias. Last but not least, Knight Swift Transportation. It's a $8.5 billion, $8.6 billion market cap. Very interesting company. I'm going to take the normal PE off of here. Excuse me, I hit the wrong button. I'm going to take the normal PE off of here so you get a little clearer picture of the relationship between price and earnings. Earnings growth has been about 13%, but there have been periods where earnings have sagged. They did pay special dividends. I think it was 75 cents and 50 cents in 2010 and then again in 2012, but they've only done that twice, so that's not something to hang your hat on. That company had froze the dividend from 2014 all the way out to 2019, actually, and then they started, raising it, and it's expected to increase. But you can see the price has tracked earnings. The market normally puts a pretty good premium valuation on this one. If I look at it from a standpoint of GAAP earnings, I get a pretty decent perspective. The price sensitivity seems to be pretty good here with GAAP earnings. And by the way, none of these are my favorite. I like to look at all of these metrics to give me a full picture of what I think the company looks like. From a standpoint of operating cash flow growth has been surging here recently. I look at free cash flows, covering the dividend. Again, I look at EBITDA. The company, tracks EBITDA at around 9 times EBITDA, 8.9 times EBITDA. It's currently only trading at 6 times EBITDA, so that would indicate that it's inexpensive on that metric. But looking at sales, it normally trades at 2 times sales. It's currently trading at 1.45 times sales. So, Knight-Swift Transportation would also be one that I'd want to dig deeper into. Now, again, I can go into my fund graphs, and I can look at things like the income statement. This company did raise capital. Okay, I think that's important to mention here. They did, issue shares in 2018 and 19. So that's for expansion purposes, et cetera. I also then want to go into the ratios graph and look at their profitability ratios. And if I look at return on equity, it's actually come down for the last couple of years. That's something I'd focus on. Gross and net margins have been very good. In 2015, they got some tax reparation, and so their actual net margin was above their growth margin. But throw that out, and the company, generates about, we'll say 15 to maybe 18 or 19% gross margins, and they usually bring 6% or 7% to the bottom line. So they've got, good margin on the business, especially considering the industrial trucking industry that it's in. So I like this company. I like Knight-Swift. It's one that if I was looking for capital appreciation, I might want to consider it. Doesn't offer me very much in the terms of dividend yield, but it does give me a pretty decent shot at good total return going forward. Long-term growth is expected to be over 15% a year. This could be a nice double-digit return type stock, going forward. And it's attractively valued and even offering a modest margin of safety at today's level. So out of all of them, Knight-Swift would probably be the one that I would be most interested in learning more about if my objective was total return. Anyway, this is the trucking industry. I kind of tried to go through how I would approach an industry like this when I don't know the companies. Once I did find a company I like Knight-Swift, by the way, I wouldn't stop here. I would, I use other research services. I'd look at things like Morningstar and, try to see what Morningstar, said, what they felt their fair value was. I don't always agree with them because they have a different way of calculating it than I do, because I want you to notice that their 5-star price is only 27. That would be closer to my fair value reference, the 5-star price, which would be their, most optimum price. I would go into other research services. I would, go into places like the Wall Street Journal and see if I could see any, news that was going on in the company and so on. And then I'd also pay attention to what's happening in the overall, supply chain sector that's going on. There is a lot of risk. Some of these numbers seem to be very optimistic and, very aggressive. I look at the analyst scorecard. It's a little bit spotty. They're only right about half the time, but that's not unusual for industrials. The consistency of earnings here is a little bit off, but recently it's been doing real well. The question is, are they actually going to be able to continue to perform with the given potential risk that might exist in the supply chain, as well as inflation, as well as a difficulty finding, drivers to drive their trucks and so on. But again, I would spend the time learning more about this company. Their website actually gives you some real nice information about what they do. I can go into the About section and learn about, the company, its different divisions, how they make money, what they do to make money, and so on and so forth. So I would, spend a little time on this company, considering that it looks reasonably attractive now if I was looking for total return, because clearly it's not a great dividend producer. Anyway, I hope you got some good insights into, how I would approach going through a research process here. And again, this is the first step prior to a more comprehensive research and due diligence. But in order for that first step to go into the second step or beyond, I want to see valuations that make sense. All right, I want to see valuations that give me an opportunity to participate in any growth in the business that I might see coming. I hope you enjoyed the video. If you did, give me a like, ring the bell, subscribe to the channel if you haven't already. And by the way, you might want to take a look at Fast Graphs. We hope to be launching this new version, which I've used here today. We hope to be launching it, hopefully late this month or early next month. We're getting real close, and I wanted you to see that, those of you who are already subscribers and keep asking me of how close we really are. You can see a lot of the processes are working. We still have a few things that aren't quite loaded yet, but our data loads are getting really good. Fund graphs are working real good. We still got some work to do on screening, but we're getting closer. Anyway, as always, I appreciate you guys. This has been Subscriber Request Tuesday. Thanks for watching, and we'll talk to you again real soon.